Keith Uti, Mortgage Alliance and Rich Mortgage. Welcome.
Thank you, Patrick. Pleasure to be here.
So we've got some ground to cover. 5 really key points that I think are important for listeners. And that is, first off, there's been some changes for rental products in terms of getting financing. And there's changes to both A and B lenders. And secondly, there's some really great opportunities to blend the A and B lending, mortgage lending. We've got private lending changes as well as commercial lending changes. And on top of that, we've got a proposed OSFI change. So what the heck is with all this changes? You know, there was a song once, I think it was AC/DC or something. No, not AC/DC. Black Sabbath is what it was. Old rock and roll. It was called Changes. So let's not do some rock and roll, but let's start at the top of the list. What's going on with these lender changes and the products between A and B lenders?
Yeah, so when it comes to the products between A and B lenders, you know, lenders are always looking at changes to their risk portfolio and what fits and what doesn't. And so B2B, one of our lenders that investors highly relied on for that 10 property mark, they've just dropped maximum 4 properties now, four title 16 doors. Like that's their maximum rental property now. So they've pulled themselves out of the game that way. But some other lenders have improved how their products work with allowing an additional property. So there's some various different factors there. And then some lenders are going, well, we'll do more properties. If you go with an insurable product, you've got a property that could be insurable. We can do 10, but uninsured will only do 5. And that's a lot has to do with their risk of how much responsibility they've got to take on your financing when they're doing that.
Now you're talking about insured mortgages. You're talking about CMHC, for example.
Yeah, for example, on an insurable mortgage with 20% down, a property that is 2 to 4 units could be what's called insurable. And 1, you can get better rates, but 2, better offsets, and 3, potentially allow you to buy more properties.
So tell me something, Keith, you know, because as we're recording this, you know, last week there was at least 3 major banks in the U.S. meltdown. And I say major, you know, some would argue that point, but we won't get into it. There's been some banks, you know, melting down and lots of talk about contagion and will it carry on. So do you think this is, you know, these changes that you're seeing in lending is a result of some of that, or has this been percolating for quite some time?
These changes happened well prior to any of that.
Okay.
Well prior to any of that. Yeah.
Got it.
So not as a result of that, but well prior to. So.
But I think, well, we're going to talk about OSFI, but I think we have to consider that, you know, we know that OSFI did increase the reserves that banks had to carry on their mortgage side of it. That was some time ago now. I guess that was maybe some forecast of what was yet to come when they did that change. It's interesting, the timing of all that. So when we talk about the opportunities that you can see when we're blending an A and a B lender, you know, what do you want to share with us in those opportunities, Keith?
Well, because of our qualifying rules, especially in a situation of refinance, a little bit on purchase, but especially in refinance, someone might be refinancing and they go, well, I want to get as much as I can in A lending. And let's say their property's worth $900,000, but they can only qualify for $600,000 of A lending, or maybe it's less. Well, that's the lowest cost money because there's no fees related to any of that or anything like that. Mm-hmm. And then they go, but I want more. I want access to more than that. But the A lender says, well, this is the maximum amount we can give you. But once that A lender product is in place, we can go to a B lender for a second mortgage product, which will be much cheaper than a private lender, but also give you access to equity, depending on what, you know, for being able to continue to expand or invest, whatever it is that you're looking to do, or do improvements on the property, whatever that happens to be. But it's a way that we can help keep costs down as much as possible on the mortgage costs. You're going to end up paying 2 legal costs because you're doing the 2 different. But when you look at blended rate over time and stuff versus just the B lending pure and all that, there really is some potential there to have a great solution.
No, I guess the part, that investors have to consider is, does this make sense financially? In other words, where's the cash flow? What is really behind it? So the workings, if you will, when you look at a pro forma of something like that, the math's obviously got to work for both an A and a B lender. I mean, that's part of what you do and the job that you do. When we consider this blended and we've talking about mortgages, give me a little bit of a sense, or give our listeners a sense of what is the lending environment like today, Keith, for investors. I'm seeing that a lot of investors are just sitting on the sidelines. Some are frustrated, some are just really afraid given what's going on and their concerns of what's happening economically. But what are you seeing? You're in the trenches. What are lenders feeling? How are you seeing it with investors? Kind of give me some dynamic of what's happening in that world.
Yeah, so as far as investors sitting on the sidelines, many of the investors that are sitting on the sidelines, so to speak, it's because they can't find property. Like especially if they're looking to buy in Alberta, if they're looking to buy in Edmonton, Calgary, and stuff. The reason they're on the sidelines is because they just can't find property. It's not there for them to buy. So that's one aspect of it. Now, as far as lenders go, lenders have kept their policies pretty consistent as far as rental worksheets and stuff, but there's some different nuances. Like there's from as little as 50% offset to 95% offset on non-subject rentals for somebody in their portfolio. That can be a huge difference, as well as on if they're buying a home that, if they're going to use the hack your mortgage method where they're buying a home that has a suite in it and they're going to use that to help them in growing their portfolio. There's so many different aspects to how those qualifying, and with interest rate qualifying being where it is right now, being able to maximize your current portfolio's offset. And then if you're buying a rental, whether it be a primary or purely a rental, being able to maximize that offset, those are two pieces that you just can't, you'd have to go to multiple banks on your own to try to figure that out. And that's where a mortgage broker really comes into play. It's because we have all those calculators at our fingertips. We can figure out where the best options are. If your debt servicing is something that is really something that's got to be is tight and needs to be a consideration.
I think that what you said about, supply, there's just no listings. I mean, supply is at its lowest levels ever. There's records being set depending on where you are in the country, to your point about what's going on in Alberta. I mean, even, certainly Vancouver, Toronto, depending on the property type, that single family detached is one of those. It's becoming very, very difficult to find those deals, and people are, reluctant to move. They're reluctant to sell unless they absolutely have to. So finding those deals is going to take some patience for sure. I'm curious, this is off topic given what we just talked about, but I want to just insert this conversation here. When we look at lending rates and mortgage rates right now, we see bond yields been so volatile, this past several months. But when you look at what's happening, how are you seeing, fixed rates in the coming months? It seems like there's a good chance that they're going to have to back off. And what's your thoughts on this, Keith?
Well, I tell you what, if bond yields were on a yo-yo, it's nonstop, right? It's just like
it's like the walk the dog part of the yo-yo trick. Okay,
yeah, walk the dog, the cradle, whatever you want to call it. I mean, it lost 40 points in 2 days, but then it's bounced up 10, and then it's just all over the place. But we did see rates start to come down a bit the end of last week. Now the lenders, they moved a little bit. We'll see where they go, where things happen on the bond yield this week on the 5-year, and see where it goes. But what people need to realize.
So Keith, what are you seeing? So, what are you seeing in terms of a 5-year fixed versus, let's say, a 2-year? Let's just talk about fixed for a minute. Forget about where they're going. Where are they right now? So if I walk up to you and go, I've got a rental property, single family detached, it's my 18th door. My bank says yes, but here's your rate. What kind of a rate am I going to get let's say a 2-year versus a 5-year?
A 5-year rental property rate is going to range from about 5.35 to 5.89 on a 5-year.
Okay.
On that 2-year, you're likely sitting in the 6.09 to 6.24 on a 2-year. The 1 year and 2 year rates are the 1 year and 2 year rates. The bond yield, if you look at those bond yields, when the 5-year went like this, they went like this. So, just be aware of that. Whereas the 3-year had a little more stability, had some of that drop built into it. So the 3-year and 4-year rates don't look so bad right now. But really, on a rental, that's where you got to run the numbers. How much are you saving? Like if the 3-year rate is 5% and the 5-year rate is 5.3%, how much are you saving on that mortgage? And is that are you really going to over the term? And that's where we have to do that calculation.
It's always the game. Okay, so we got into mortgages. We're talking about A lenders, B lenders. What's going on with private money? The private lending changes. I don't know how much private lending you're seeing, but I mean, you obviously are. It always seems to be happening. But what are the changes that are going on in the private lending world?
Well, I tell you what, the biggest thing in the private lending world is they've upped their rates, right? They've just plain and simple, they have upped their rates. About 2%. Is about a 2% higher than where they were. So where a 7.25 was maybe possible a year and a half ago, that's now 9.25. So it's very, and that like if you're below 65% loan to value, that's where you're going to get the best rate, and that's always been that way. But if you're trying to get the 75-80% loan to value, don't be expecting that you're going to see anything that's got something lower than a 9 in front of it, because it's just like the private lenders, their cost of money has gone up as well, and they're trying to maintain margins for their investors, and the only way they can do that is they pass it along to the consumer. And some private lenders will negotiate fee versus rate versus fee, but that's part of depending on the scenario.
Well, private lending aside, off topic a little, is that I recently have received, over the past 2 months, I've received 2 A lender offers, arbitrary offers for lines of credit. I bank with both of them, and one will give me $50,000 at 10.25%, and one will 10.25%, and one offered me 175, some random number at 10.5, and I went, oh boy, isn't that a great offer? Not. Anyways, it was total random. I wasn't looking for money. They just were pitching the deal. So it seems that they're still looking to lend money, is my take on that. Anyways, it was quite shocking at over 10%, Keith.
Yeah, it's not.
Okay.
So be aware of that when you're running your numbers.
Yeah, totally. And so what about commercial? Because commercial is, I don't know, I guess where you are. It's in flavor or it's out of flavor, or in favor or out of favor, depending on how you want to say that. What is it looking like for lending with commercial?
Well, I think the biggest thing that's impacting commercial right now, and I'm going to first talk about just standard financing. So standard commercial financing, the biggest thing is those fixed rates on standard commercial financing are impacting debt service coverage ratios, which means your loan to value that they'll lend you is being pushed down so much. And that's the biggest factor with that standard commercial financing, is those debt service coverage ratios usually have to be at least 1.25 or better. And how do you to get 1.25 when the rates are that much higher than they were before? In some cases we're talking 8-9% for a fixed rate, maybe a floating rate of 1.5 prime plus 1.5 to 2. So you're talking, even at that, you're talking 7.7 to 8.2. That impacts debt service coverage ratio, makes that loan to value harder to achieve. CMHC side, similar impact. Rates are not as high, especially now that the bond yield has come down. If you're closing this week, you're golden, because of where rates have moved down. But otherwise, but still, like compared to a year and a half ago, debt service coverage ratio, even with the CMHC, the 1.0 on the MLI Select or 1.1 on the standard, still harder to achieve those when you consider that interest rates have come up, and if the property hasn't had its rents increase, that can be difficult to meet.
Wow. So, we say it all the time. I think it's a great time to just remind people is that, investing is still, in spite of the supply issue, when you can find those deals, you also have to get the financing for it, plan ahead, reach out to somebody like Keith, Keith within Rich Mortgage, make sure you're tapping into that level of expertise, because the next and final kind of topic is that OSFI is making some changes. Now, the point of me suggesting and recommending highly that investors work with an investor-focused mortgage broker is that these changes are happening, it seems, sometimes weekly. There's nuances, there's little shifts depending on what bank you're dealing with, A lenders, B lenders, credit unions, and then, of course, private lending. And then along comes OSFI and says, okay, we're going to throw in some additional changes. Tell us what OSFI's got in mind.
Yeah, well, you know what, Patrick? I look behind you and I see those boxing gloves, and it's kind of how not just investors, but even just home people looking to buy a home feel. They feel like they keep taking a shot, and they need to put that hockey helmet on that you've got back there with those boxing gloves just to handle the blows. But so right now, the changes OSFI has proposed are out for public comment, and anyone can respond to this via their email and answer. There's 4 questions, and you can send in your responses to all or any one of those questions as far as what your comment is on that. But they're proposing things such as loan to income and debt to income restrictions, debt service coverage restrictions, meaning that even though you have a current mortgage that's at 2.29 with a payment of only $900 a month, they want to force the qualifying to be using benchmark or the current fixed rate plus 2% to figure out what the payment would be if you renewed at this higher rate, and use that in your debt servicing. Things such as that, credit cards, and for credit cards and lines of credit, they want to limit lenders that have flexibility in the unconventional space for mortgages to not allow them to have flexibility over that 39-44 debt service ratio, not allow them to consider exceptions for up to 48% or 50%, things like that. So this is just a touch on that. If you really want to see what all the proposed changes are that you can publicly comment on, look up OSFI. It's OSFI-BSIF.gc.ca. So it's the English and French version of it. But you go there, you can look it up, you can see it all, comment on it. If you're an investor and you talk about wanting to be active in your business, these are ways that you can be active in your business, because this is going to impact you and other investors if these move through. Do they have a different view on things based on things that have happened in the US? Well, it could be one of 2 ways. It could be pushing them going, yeah, see, we need to be doing this because look what happened. Or could they say, wow, with that's happened, maybe economy is going to peel back a little bit and maybe we don't need to be as aggressive. I mean, we don't know how they're thinking in their brain, but we know this. They've already put it out there. And when they put it out there, that usually means there's some change coming. Just what is it going to look like in the end? And it would likely, if April 12th is the comment date, likely implementation for June, July of this year.
Beautiful. Keith, UT, thanks so much. And Rich Mortgage Alliance, folks, if you're looking for mortgage support, and whether that's an investment property or even your home, reach out to Keith. He'll get you looked after. As I've said, Keith, these insights that you provide are really important to make decisions and to really highlight the fact that you need to work with a mortgage professional. And I want to say thanks for your time. Appreciate it, my friend.
Hey, you're welcome. Thank you for having me on today and giving a chance to just help people see what's going on out there.
Beautiful. Thanks, man.
Okay, take care, Patrick.